Afternoon, everyone. So I'm Dan Coatsworth. I'm editor of Shares magazine. So I'm here today to talk about picking funds. So I wanted to talk to you about box of chocolates first. I thought chocolates would be quite an interesting way, given it's Christmas. There is a relevance to picking funds, so bear with me. I just think, let's imagine you've got a box of Quality Street. You may dip in, you just take the first one that you find. You kind of think, okay, this is good. I kind of assume it's going to be tasty. I feel quite satisfied. But if you compare that to a posh box of chocolates, you might have a nice little menu which details all the individual flavours they've got in there. You probably give a bit more time thinking about what's there. You look, think, oh, I like those, or I don't like those. And you give it a bit more thought. Then you pick the one that perhaps best suits your needs. So you're wondering, how does this relate to picking funds? Well, I certainly know from experience that there's probably two ways that quite a lot of people go about picking funds. One is they think, well, I've seen adverts for big asset managers. Maybe when I'm at the train station, you see these big billboard posters. I think, oh, Jupiter, I've enough heard of them. I'll just buy one of their funds. Another way might be to look at your SIP or your ISA provider, look on their website and see what's the most popular funds at the moment, because they tend to list their top 10 buys for the last month. You think, well, everyone else is buying those funds. I might as well have one. Surely everyone must be right. But actually, is that really the best approach? I think, now this is where it goes back to the chocolates. If you go back to the box of chocolates, it shows you're giving a lot more thought to it. Actually, I think you do need to give a lot more thought when you're picking funds than simply either going with the mass crowd or just thinking, buy the first one that you see. But the only problem is, with the funds industry, it's slightly bigger than the 10 chocolates you're going to get in a box. Unfortunately, it's a lot bigger. So here we are. These are just some quick stats I found. So I reckon this is just for UK investors. Forget about the rest of the world. There's 3,000 unit trusts and OEICs, about 1,000 ETFs, 350 plus investment trusts, and 1,000 VCTs. And quite frankly, the financial services industry is not making life easy for you or I, are they? There's so much choice. But what I'm saying is, don't get overwhelmed, because actually there's quite a simple way of stripping down the choice to a much more manageable list. So I've come through 8 steps. It's quite simple stuff, and I appreciate some of you here may already be investors, and you might know quite a lot of this stuff, but I wanted to keep this quite basic. So, so we just go through them one by one. So this is your investment goal and your time horizon. So for argument's sake, we'll just say everyone here, we're going to be investing in funds because we want to save up for a nice pot of money when we're in retirement. So your goal will be retirement, and it will be how much money should I have once I'm in retirement to fund the lifestyle that I want. So I use some investment calculators you can get free on the internet. Aviva's a great one. Just go into Google and type Aviva investment calculator. And this is a great example of, you can put in a pot of money which you want to have into the calculator, and it will tell you how much that you need to invest every month based on a certain time period in order to hit that goal. So your time horizon will be how many years until you reach retirement. So the risk appetite is very important, and it's influenced by a lot of factors. But if you're younger, you might be happy to take on some higher risk, because potentially you might get some higher rewards. But if you're older, you perhaps don't want to take on too much risk, particularly if you're approaching retirement. You think, oh, I don't want to start my golden years by having a dent in the portfolio because I've just invested and the stock market's been through a wobbly patch. So perhaps you want to think about, I'll do some lower risk options. So avoid funds that may invest in miners, biotech stocks, oil and gas stuff. These are very volatile assets. Yes, they may go up and they're exciting, but they can go down as fast as they go up, unfortunately, if they don't get things right. But this puts us in a tricky position, because if you've gone on your online calculator to work out how much you need to make each year, buying a very low-risk fund may not be appropriate. Let's say if you need 12% a year in order to hit that goal in the future, you need to find a balance between taking on enough risk to generate the desired returns and not being too bold so as to risk putting a dent in your portfolio. So step 3 is income or growth or both. So if you're saving for retirement, many people might just prefer capital growth and think, I'll just let the value of my investments grow slowly. But actually, don't ignore dividends in this situation if you're still in this accumulation phase. Because taking cash payments as dividends can give you various options. First of all, it could create another pot of money for you to diversify your portfolio and perhaps buy some more funds. Alternative is you can buy some funds that automatically roll up the dividends in retirement. Automatically roll up your dividends. So you own more funds without actually having to put your hand in your pocket to pay out for more money, pay out more money to increase the size of the portfolio. Because when you reach retirement, you might get to the point where actually I can just flick from having the same fund with the accumulation version. I can just switch to having the income version, where I've still invested in the same things that I've done my research and I'm quite happy to own these things. So this is where it gets a bit more interesting. So delving into past performance data, I think this is the point where a lot of people may think, I'm just going to look at stuff that's done really well in the past and assume it's going to continue doing so well. And then you might think, well, I've looked at some stuff that hasn't done very well, and I'm just going to ignore all that. And that's actually a slight mistake. So you need to understand the bigger picture, namely how the broader markets were performing, and whether a fund should have underperformed or outperformed due to the style of their strategy being in or out of favour. Now, I like to look at discrete annual performance data to get a better picture of this fund. I like to look at 5 years or 10 if possible if the fund's been going that long. It will help to see whether the fund has delivered fairly consistent returns, whether actually it's just had a couple of really good years and quite a lot of bad ones, which it can be masked by. Let's say a fund's gone up by 80% over 10 years. It might be that 8 out of those 10 years, it's not done anything at all. It might have lost a bit of money. But in 2 of those years, it's done amazing. So when you might see some past performance data quoting the 10-year period, it might say, yeah, we've done brilliantly. But really, it's just been fund managers got lucky for a couple of those years. I think the skill of someone looking and researching for a fund is to check whether that performance was genuine skill or luck. It's like going to a casino. You might go once and you win, and you think, this is great. That's well done, that's a bit of luck. If you went every week, I bet you over time the casino would win. It's actually genuinely hard to be lucky over a long period of time. Luck is separated from skill, and you must understand that a fund manager who can actually deliver fairly consistent returns year in, year out is very, very good. So step 5 is to look at what's doing well and what's doing not. This year, a lot of the best performing funds may have had tech stocks inside. The tech sector's done very well. But you can't assume that tech will keep going up forever. That's why I think it's really important to look at performance in the context of the wider market. I think it's really important also to look at stuff that isn't performing well, because actually some of these could be the really good things to hold over the long term. Let's think about value investors. They look for opportunities to buy shares that have been incorrectly priced by the market. But at the moment, we're in a market where everyone's just chasing growth stocks. They're paying very high valuations simply to back a company that seems to be doing well. But value stocks won't do, a value fund won't do that well in this environment. I personally own an investment in J.O. Hambro UK Opportunities Fund. It's not done anything at all. It's been a very frustrating holding, but there is a reason why I got attracted to it in the first place. It's very strict on valuation, and it will sell a holding when its valuation looks excessive. Now, hang on, I know some of you are going to say, well, I've always been told to run my winners. Why would you want to sell something, even if it's overvalued? Because surely we assume that we keep holding it until it starts to fall. But actually, I think there's something quite good about selling winners when they're overvalued, because you're sticking to a very strict principle. When I looked at this fund a couple of months ago, it was underperforming the FTSE All-Share by about on a 1 month, on a 3 month, a 12 month, on a 5-year basis, and thinking, this is not very good. But actually, if you look at it over the last 7 years, 4 out of those 7 years, it's done very well. And actually, in every single 7 years, it's delivered a positive return. It said to investors the other day, I've got a quote, it says, there remains no value in this market, and we continue to stick to our valuation discipline rather than fold as the craziness reaches its peaks. I think this is a really interesting comment. Now, I'm just going to show you a couple of charts from a different fund that sort of plays on this theme. So you can see here, I'll tell you the fund's name in a minute, but we'll just call it a well-known fund. So over 10 months, this underperformed the market by 22%. So I bet you, if you were looking for funds at the moment and you came across this, I don't reckon many people would go, I really want to buy that, do you? And actually, I think that might be a bit of a mistake. So here you are. There's too many people who rely on past performance to inform the decisions. But actually, if we talk through this one, I'll tell you why it's an interesting point. So this fund subsequently went on to outperform the markets by 143% over the subsequent 14 years, so directly after that terrible 10 months. And the fund is Invesco Perpetual High Income. Actually, the fund manager at the time was Neil Woodford, who's back in the papers again, because he's underperforming the market. And everyone's saying he's rubbish. And there's like, why have I wasted my time? But actually, the guy has made loads of people money, and he's got a very strict investment discipline, which I think people should not forget. And he said some really good stuff. He said, I'm really sorry for this performance I've done since 2016, but in terms of what it means for me as a fund manager, it's very important through a period like this to maintain your investment discipline. The temptation is to take the easy option, hide in the strategy that everyone else is pursuing, and then all the fuss, criticism will just go away. But that would be a betrayal of my investment principles. So I'll leave it to you whether you think that Woodford's any good at the moment, but he made people loads of money, and I don't think his investment approach has changed. So understand each fund's investment process. So this is sort of help you spot if a fund has a certain discipline, or how their fund style might be categorized. Most of the asset managers these days have got really good videos, they've got articles on the website explaining what they do. They're talking about what they want to achieve and how they'll go about doing so. And I perhaps would say, if you look at a fund manager and looking at their funds and they don't explain any of this, I'm not sure you really want to be putting your money into them. You need to have faith in them. It's like, why would you hand your money to someone else if you don't know how they're going to use it? So examples of investment processes. So it could be backing young companies that have the potential to be much bigger in the future and which could disrupt traditional markets. It could be finding companies which are really good at generating high returns on the money that they invest in their own business. It might be building a portfolio of companies that play to a specific investment theme, like how to profit from an aging population. It's really good. I like funds that have a clear discipline and tell you what they want to do. I don't know if anyone's looked at Lion Trust Asset Management. If not, I suggest that's the first thing you do tonight. Look at their website, because it is seriously amazing in terms of how they explain what they're trying to do. It says it's trying to help investors understand how its teams manage money and the fact that its process is predictable and repeatable. Good fund managers are very hard to find. And I think you should only invest in them if you think that they can outperform the market. If not, just invest in a passive fund like an ETF. I think you should only invest in a fund if it has value for money. I'm happy to pay a little bit more for what perhaps some people would call an expensive fund if it's actually delivering for me. A lot of people talk about, I'm going to pick this actively managed fund because I've looked at the costs and the costs are low, but you've kind of forgotten about the rest of the stuff. You don't really know what it does. You think, just invest in stocks. But I'm not so sure that's a really good approach. I think if someone's good, I don't mind paying up a bit more for them. So by this point in your research, I think you should have a nice potential shortlist of funds you want to look at, but your work's not done yet. I think you need to double check that you haven't missed anything on the costs and the risks involved. But there is a document that can help you. It's called a KID, a Key Investor Information Document. And you'll see this with all fund information, because they've got to have them. And it will show you a bit more about clarifying the facts and if the funds could help you meet your investment goals. It talks about what the fund's trying to achieve and how they're going about it. It may be a bit more dry compared to the information you see on a fund manager's website, but they're really valuable to look at. So I don't know if you probably recognise this if you're investing funds. This is an example of what you'll get in a KID. This is a risk slider, so 1 being the lowest risk and 7 being the highest risk. So each fund will be categorised. It'll also show you some past performance data. You might see other links to other fact sheets which talk about the top holdings in a fund or what the fund manager's been doing over the last month, a bit more about the history of it, the fund manager, what they do, and some more past performance. You might also see something called a Sharpe ratio. And this is kind of a quick way of thinking about whether you're being adequately rewarded for the risks that you're taking. I think if a fund takes a lot of risks and your rewards are good, it should have a fairly high Sharpe ratio. But if a fund takes lots of risks and the rewards are pretty poor, you'll have a low Sharpe ratio. So it's a rough rule of thumb. Sharpe ratio is above 1, it's good. Above 2 is really good. If it's above 3, it's amazing, I'm told by my colleagues who are experts at this. To number 8. So trying to explain the researching funds is actually it's very interesting, and it will take a bit of your time. I think your time is well spent doing this. But I appreciate there's going to be some of you who just want a list given to you, short list, already done, the hard work, and think, what can I buy? Well, there is a solution for you, because quite a lot of the investment platform providers, the places where you get your SIPP or your investment, your ISA and stuff, they'll have lists to show these are our best buy funds or our favourite funds. I think these are quite interesting, but what you need to do is to look, how have you come about this list? Have you just been picking all the best performing funds, all the ones that invested in sort of the trendy stuff at the moment? And if so, I'm not sure that's really the best way about it. So I would ask, if you see in these lists, go and ask the people who put them together, how did you compile it? And if they can't answer, I think you should look somewhere else. So I've got a little screenshot here. This is AJ Bell's got a favourite funds list. And within it, it's split into passive and active funds. So on the active side, there's 50 actively managed funds. And it's been selected for being low cost, great value for money, proven track record, and a high-quality fund management team. Now, AJ Bell didn't put this together. They worked with a company called Square Mile, who's an independent research group, who are expert of funds. So they've done a lot of analysis into this. So that's the kind of information I expect. If you look at any of these best buy lists, you need to find out exactly how it's been put together. So you can see here, you're able to actually filter this down to if you're looking for specific things. So you probably can't see the back, but I've ticked income, and I've ticked it here to go, I want global assets. And it's narrowed down this choice to 3 funds at the bottom. And then I can go and look at their KID document. I can go to look at each of the websites, have a good research, get to know them better. Now, if you don't fancy this, there's another alternative is to look at fund ratings by Morningstar and Lipper, which are free. If you go onto Morningstar's website, you see sort of 4 stars, 5-star rated funds, and they'll explain why. But these are just some examples of ways in which you can find more information or quick pointers to help you narrow down the funds universe. So I appreciate I've gone through quite a lot of material in that 20 minutes. Hopefully it's given some pointers. Now, I'm told that all the presentations today have been filmed, including this one. So if you want to go back, look at some of the information that we've been giving you, please do so, because I think they're going to be uploaded onto the event organiser's website in the next week. So in which case, best of luck picking your funds. Thank you very much for listening. Merry Christmas, everyone. Thanks very much.